Good afternoon, everyone. Thank you for joining us today. This is Connor Global's webinar and live Q&A on how is cannabis investing in a downturn different than other industries. The webinar will be moderated by Murray Henneke of North Point Advisors. I will leave it up to Murray to tell you more about the session, but I did want to let you all know that Connor Global, as you know, has been doing investment conferences for family offices and ultra high net worth investors in the cannabis industry, and we've recently switched over to doing webinars in the meantime while things are cooling off. So if you have any requests for topics, wish to join as a speaker, please let me know. We are planning to do a couple a month. So anyways, I will hand it over to Murray to take it over.
Great, thanks Noah, and thanks everybody for being on. This webinar is about COVID-19 and its impact on cannabis stocks, on cannabis investing, private and publicly, and how it's impacting companies. And so we've got a great group of panelists, and I'm going to have each introduce themselves, and I'll kick it off. I'm Murray, and North Point Advisors is based in San Francisco. Traditionally, we worked with consumer companies, so wine and liquor, consumer packaged goods, restaurant companies, all those types of things, doing mergers and acquisitions and private placements. I joined 2 years ago to manage the cannabis practice, and we've been fortunate to have a great stable of clients. And anybody can feel free to reach out if you want to talk more about what we do at North Point. And I'll turn it next over to Matt. You want to take it from there?
Sure. Thanks, Murray, and thanks, Noah, for putting this on. My name is Matt Hawkins, founder, managing principal at Entourage Effect Capital. We've been investing in the cannabis space since 2014. We have 65 investments over 2.5 funds and several special purpose entities. I say half funds because we're still raising our third fund, which is challenging in these times, but we're still getting after it. And remain bullish on where this industry is headed. And I think with COVID, there's been a lot more positive than negative to come out of what we've seen the past couple of months.
Great. Mitch, you want to go from there?
Thanks Noah for arranging it, and Murray for mediating, moderating. Maybe it'll be mediating. We'll see how it goes. This is an opinion, but I come at this space originally from a legal background. I was the general counsel of Steep Hill Labs in Oakland in 2013. When I was there, I saw the need for what I call East Coast capital and professionalism in what at that time seemed like a very West Coast movement. After doing that for 3 years, came back to New York and started a law firm with my partner Dave Feuerstein to service the cannabis industry and to start to make some of those connections. We were 2 lawyers. People thought we were crazy, starting a law practice in New York City for cannabis, because as you all know, New York is not really where cannabis is currently. But here we are 4 years later, 17 lawyers practicing cannabis law 24/7, and we attracted the interest of a former fund manager, John Licaretzis, who ran a $4 billion fund, and with him we moved into his office and we've launched a cannabis fund called Focus Growth Capital Partners. And so we have a robust legal component to the fund, but also a lot of deep Wall Street and credit underwriting aspects to the fund.
Okay, terrific. Thanks, Mitch. Michael, you want to take it from there?
Sure. My background is as a CEO and business operator, primarily in the health and wellness space, and some CPG, and have built a couple of top 1,000 brands in the United States. I'm one of the founding partners at Primary Growth Partners, and we fulfill mission critical roles for early stage, emerging, and legacy cannabis companies with a focus on bringing operating expertise across strategy, branding, marketing, operational efficiency, and legal compliance.
Okay, great. Ryan?
Thanks for having me today, and Thanks for moderating. I've been investing in the space for 6 years now, privately, as well as a GP of a fund based out of Hong Kong. I'm an advisor to a few different funds and an LP in a couple different funds, giving me good exposure and a good vantage point into where this is all going and where the pain points are. About 7-8 hours a day, 7 days a week is spent on an operating company that I co-founded here in Massachusetts. It's called Revolutionary Clinics. And I really try to weave my private portfolio, that of the groups that I'm advising, and our operating company in together in a holistic way to really work in unison. Thanks for having me.
Great. Thanks, everybody. So I'll go ahead and kick it off with the first question. The format generally is I'll ask questions for probably half an hour or so, and then feel free to chat with me if you want to ask questions. We can take questions from those that are listening or on Zoom with us. So first question is just on the macro environment. This is headed first towards Michael, but everybody please chime in. Just last week, we looked at the S&P index versus some of the cannabis indexes beginning March 1st. So kind of looking at, since COVID really broke. S&P was down 8.5%. Cannabis indexes were down roughly 13%. During this time period, obviously cannabis was considered an essential product in most, not all, but most states where it's currently legal. I think it's a great step forward for the cannabis industry, but the stock performance is actually worse than the rest of the economy. I'm curious, Michael, as to why you think that is.
Yeah, look, I think there's a disconnect between the index for cannabis and what's actually happening in the industry. And I think there has been for a period of time now. I think the publicly traded CSE, TSE companies got punished. They had this big stock drop in 2019, started mid 2019, into the fourth quarter, that really was based on performance and missed projections and objectives, et cetera. And it's punished the whole industry, right? Valuations have dropped up and down the ladder from the publicly tradeds all the way through, pre-rev startups. And I think that disconnect continues to exist. So the data that I think is more telling is what is the industry doing overall? 2019 over 2018 looks like an $8 to $10 billion bump in contribution to the economy, or in sales at dispensaries, plus the when you trail that business back. So significant growth, one of the fastest growing industries in the United States at that measurement. So I think that's a far more telling statistic than the index. There are other factors impacting the index. One of the big ones being liquidity, right? How are the liquidity that those companies have and expected performance based upon a lack of liquidity for many of them. And that's impacting the index, I think, as much as anything else right now.
Great.
I also think that,
thanks, Ryan.
yeah, I think that so many of these entities haven't been tested compared to the rest of the markets that are available to us. And so I think it's to be expected that the bottom was going to fall out further. But now that the bottom has gone in Q3, Q4, pre-COVID, obviously, the air was let out of the balloon. And then during COVID, all ships sunk. I think those that have regained their footing in this crazy time and changed SOPs and changed what they needed to do to prove that they can remain cash flow positive or remain going concerns, I think that they have even more uplift to experience because they were more severely punished on the way down.
And if I could just add, I would to me, when I thought about this, I was thinking that the lack of institutional investors in the space, which has been a problem just for liquidity in general, also is when these stock prices are rapidly declining, when you have an institution that's backing a company, if it liked it at 32, at 23 it might be a buyer, and that as a result you have like the support at a certain level. With the base of investors that exist in cannabis, being more retail, when that, it's like catching a falling knife, right? And no one wants to do that. No retail investor wants to do that. And so I think, that's a big part of why those stocks have fallen. It just goes back to the lack of institutional investors in the space.
All right. Matt, any comments? Or are you good?
No, I mean, I agree with everybody. I think the beginning of this was when the companies had their unrealistic expectations on what the conversion rate of the illicit market was, which therefore led to projections that were, ludicrous. But I agree with Mitch on this is primarily driven by the fact there's not institutional capital to hold these stocks up, because you have retail investors who just want to get out. I think indirectly, and this will probably is a nice segue to whatever you're going to ask next about just COVID impact, but anecdotally, I think whether we can measure it or not, I think there's probably some pretty good reasons to believe that the illicit businesses in the legalized states are starting to get tamped down for no other reason than that people just aren't going to see their guy. And they're going to utilize the services that are in place by our licit retailers with curbside pickup, limited foot traffic in the stores and delivery, especially with the states that are using kind of the lax regulations on that.
And Murray, if I can add, I think there's a second piece to your question, which had to do with the designation as essential businesses, right? And why hasn't there been a pickup from that piece? And I think, look, it's an important thing that cannabis has been designated essential. It sort of lifts the profile and perception of the industry, but it's only been designated in states and localities where it was already legalized. And so what the essential designation is not translated into is any movement at the federal level, right? There's been talk of tacking on banking provision to one of the SBA relief packages, or including cannabis businesses in one of the SBA relief packages. That has not happened yet. Whether it will happen or not, I think, is an unknown. And I think that it's like the fuse has been lit with essential business, but the explosion hasn't happened yet. I think that designation will help when in the aftermath, the analysis of this, the post-mortem, if you will, that it was deemed an essential business but still had to conduct transactions in cash, one of the most germ-filled financial transaction systems there is. And it's sort of ridiculous that there wasn't access to more modernized banking transaction apparatuses. So I think it's lit. I don't think we're seeing it impact the industry truly yet.
Well, I think that you're not going to see it move on the federal level or see that essential business designation excite any change on a federal level until you see the economic impact of the contributing margin in taxes when the cannabis companies are able to continue. So the growth opportunities for these cannabis companies to continue to hire people, as well as the tax that's coming off of the revenue generated, I think that's how the excitement gets sparked in order to have federal change.
Sure, I agree, and I'd contend it's part of the reason they were designated essential. The states didn't want to give up that tax revenue on what is one of the most highly taxed consumer product goods in market.
Yeah, I can tell you it's painful here in Massachusetts.
Yeah,
it's not essential.
Right, as it is essential in Massachusetts, but not adult use, right?
Correct, which, as we've all seen, 70% of adult use users are using for some self-prescribed reason, sleep, anxiety, etc. And so it is pretty complex. That said, the increase in card holders, medical card holders in Massachusetts has gone up considerably, but nothing close to what the adult use market was seeing in Connecticut, Rhode Island, or New York.
Right.
We can get more into that later.
Okay. Yeah, a couple points from my end on the essential nature of the products. I mean, first is just from a high level, who would have thought 5 years ago that the cannabis in this kind of crisis would be an essential product? As fantastic that it is. But in California, where I live, I think it's especially important because if it weren't being potential, it really would help the black market considerably, I think. And it's really kind of been a key way to kind of keep the black market at bay in the short run. Next question, I'll direct this at Ryan. So given all the craziness of the markets and everything else and the sheltering at home, what's an investor to do if they wants to invest in cannabis right now? Should he be investing or she be investing in cannabis? And if so, how, what are some of the right moves?
Yeah, it's a fascinating time. I've talked to a lot of people about the mere fact that a lot of conservative investors felt like studying the market during 2015, 16, and 17 was the right thing to do, and then take those learnings and invest in 18 and 19. And the folks that did that are the ones who have lost their shirt to the greatest degree. People that had early vintages, even if it's a blended portfolio over time, they have stayed in and they realize that there's a bubble nature to this industry. There's a real ebb and flow, given the complexity of the federal illegality and removing the illicit market, and communities just getting used to this new industry. So this reset, the original deflation in Q3, Q4 of last year that seemed to start to turn around Q1 of this year, and then the bottom really falling out from COVID. This reset is an opportunity for those that aren't too beat up from their general portfolios. So as I said before the call, the way that the question is phrased is an interesting one. How do you make money during COVID? I think there's an element about this being, how do you generate cash during COVID? How do you come into the market during this time where a lot of equities are on sale? And then what does life look like coming out of it? And I think coming out of it, it's actually far more interesting. Investors can, of course, dollar cost average on the way down. I personally don't believe that we've seen the end of severe volatility in the general market, and the cannabis industry is just generally an order of magnitude more volatile on the way up and the way down. And so you need to be cognizant of that. I think that we won't see new lows in cannabis or the general market. So I feel like we're on more stable footing today than we were 2-3 weeks ago. But I wouldn't say that a dollar in today is going to have a very smooth ride up back to the highs that we used to see, or even moderate highs that we used to see. So how I'm spending a lot of time, I think, frankly, to prop up everybody on this call but me, because I don't fundraise for a blind pool fund or any of these private equity funds. But I think now more than ever, thorough portfolio construction is critical. There are private investments that I'm in, that I've been in for the last 3, 4, 5 years, that I frankly don't have time for right now. And the fund managers who have put in more capital in subsequent rounds are the ones that are really helping those companies through such struggles. So that's a big part, is leaning on peers, professionals, and cohorts during this time. I think there's huge opportunity for distressed. We're seeing a number of MSOs default, large and small. And frankly, from 12 o'clock until this call started, I was on a call about a potential takeover with a fund around that. So SPVs are interesting. Looking at distressed assets to fill in gaps. If you have a portfolio of technology and there are capabilities that you don't have, but other people's balance sheets are stressed, I think it's a good time for fold-ins. And then more on the ground, I'm looking at ancillary elements of this industry that are touched by the more legacy industries of waste management, coming and picking up everybody's wasted biomass that isn't THC. Growth supplies on commodities. Where is this chocolate coming from? Where are people's sugar coming from? Where everything that's going into their products other than cannabis. Staffing is going to be really interesting now that there's 26 million people that have filed for unemployment, and this is a growth industry. I think that's a really exciting spot to look. And I'll end, because other people have great opinions on this with larger portfolios than mine, but I'll end by saying now is an easier time for forgiving or forgetting the fact that it's very difficult to go on site to due diligence. It's an easier time to get the truth out of employees and out of these companies. Egos have been deflated considerably in this space over the last really year and a half, but of course right now there's a new level of humanity in the space. But also, folks are being laid off, they're being furloughed often. There's massive change even at the management level. And so to be able to dig in with past and former employees about the distress or the proper functioning of a team amidst chaos, that's gold for an investor. That's really, really meaningful to be able to talk to people who are furloughed, but they were given every opportunity to help their family maintain their health care, other things that will really tell you a lot about the company. And so I feel like I'm getting a better look under the hood now than before.
Great. Matt, you want to add to that?
Sure. I'll start with agreeing with Ryan's last point. Short of it being impossible to go kick the tires on site and seeing the whites of people's eyes on Zoom, it is a pretty good time to invest. And I hate saying that because that's one of our requirements to making a new investment is obviously seeing the facilities, breaking bread with the owners, et cetera. So that makes it tricky. But for us, we have, including SPVs, we've got almost 30 investments in our second fund, and we still have dry powder in our second fund. And so we're spending a lot of our time figuring out where to deploy our follow-on capital into our existing companies. We're not making any new investments out of Fund 2, which is why we're starting to raise Fund 3. But in Fund 2, we see opportunities to create scale internally. And it's our opinion that as we drive towards the point of some type of quasi-federal legalization or full legalization, scale is going to be what matters, because you don't want to be in a situation where there's a buy versus build question when institutional capital comes into play. So we see a lot of the overused word synergies in our portfolio to put people together and capitalize them further, maybe even reducing our cost basis with what we've done before, all the while still incentivizing management to drive this further. So that's where we see the real, quote unquote, new opportunities to look at during these times.
Great. Any of the other panelists want to comment, Mitch or Michael?
I would just add super quickly, because we have Ryan on the phone, sort of interesting, right? And we talked already about Massachusetts, curtailing adult use. So you could have had a really good operator in Massachusetts, let's say, but didn't have, and a good balance sheet with a good management team, but not maybe a diversified portfolio. And all of a sudden they're in distress because of COVID. You could believe in the team and believe in the state of the Massachusetts state construct. Is such a believable marketplace. It's a place that you would want to put money for sure, but you might have this opportunity now because of COVID and this particular market circumstance in Massachusetts to partner with somebody that you might not have had a chance to partner with before, because they were, I don't want to say making money hand over fist, because we all know how hard the industry really is to make money, but I think Massachusetts was enjoying the highest price of wholesale flower in the country. And so if you were participating in that, it looked pretty good 2 months ago. And so COVID has created a situation where that may have shifted. And what that creates really, whether I was just using Massachusetts as an example, but what it's created across the country is leverage, right? And an opportunity so the way that the question I think was, what's the best way for an investor to make money? To me, and the way that our fund looks at the best way to make money is through smart structures, right? You structure an investment, and when everything is flying high, it's hard to structure in a favorable way because you don't have the leverage. But now, the investors have people who have dry powder have the leverage, and I don't mean to suggest to use that in a parasitic way. I like the word that it was used before by Matt, like in a synergistic way. You're looking to, when we launched Focus Growth Capital Partners, we decided, are we going to call it an opportunity fund, or we called it a capital partner, right? Because the idea is to find people and teams you believe in, and then apply capital and partner and do what Matt talked about. Crossbreeding your portfolio to help everybody to lift everybody up. So to us, it's about structure, finding the right management team, and seeing someone who, because of this market condition, primarily because of COVID, is now finding themselves in need of money.
Okay, we've gotten some great questions that have been coming in through the chat rooms and stuff. One of the questions relates to this, and that's what's happened to valuations from your guys' perspective. Have they gone up? Have they gone down? Mitch touched on the structural side of things, but just what's the environment right now over the past, since COVID-19 began?
Well, it's exactly what Ryan said, that egos have been tamped down and valuations are low. And if you like the business and the underlying story and metrics behind it, it's a wonderful time to invest for all the reasons we've already said. And to Mitch's point, structurally, this is the first time since we've been investing, which has been since 14, to where we're really driving the ship here with how we're all accustomed to investing in our private equity days prior to this, is that we get to do, and look, it happens in every sector. It always rotates from the buy to the sell side on who's in control. And right now the buy side is in firm control, but it's very, very, very slippery in that you don't want to get to a point, especially like us, when we're not operators and we're not control investors, but we're very active investors, with a minority position. We need to align with our management teams, and that's who we're backing ultimately. So you got to make sure that it's not egregious enough to where you're misaligned.
But Matt, I totally agree. But there's, when you were asking about valuations, Murray, I mean, it occurs to me that, a stock that may have been valued at $100 million, last year, which is now 20 million, doesn't necessarily make that 20 million a good value either.
Oh, no. And I was primarily focusing on private companies. I think you really got to separate it from private to public. And I was kind of giving a blanket private statement, but Mitch, you're absolutely right.
Right. And so to go back to the idea that I agree with Matt saying, I mean, the opportunities are there. But you still have to COVID hasn't changed everything, right? I mean, you still have there's still smart due diligence, and there's, looking at a balance sheet and looking at a diversification of a company and their management team and their track record. What has changed is it's just, we sort of have this saying right now, which is that COVID has accelerated the future of cannabis, right? It's just accelerated a lot of things. And here, the capital markets were already tight, and it's sort of really accelerated and deepened that. And so it's created these opportunities, but it's also, it's accelerated things like delivery, in states that didn't have it. And so it's created a whole host of other opportunities, but it's still, at the end of the day, it's still investing, in partnering with, a team and a business plan that you believe in.
From where we sit, and we look primarily at really early stage through emerging, right? Most of our clients are $10 million a year, under $10 million a year in revenue. A couple of them are over that, but most of them are under that level. And what we deal with a lot is, there's just their awareness of certain parts of their business. And what's really coming to the forefront now is liquidity, right? They've woken up to the reality of liquidity. And I think that is impacting valuation, and that sort of sense of humility or lack of bravado that Matt was referring to, that sort of has disappeared during this. Right? They're getting much more honest about liquidity, really looking at liquidity. What is their runway? What's the impact going to be of a slowdown of their receivables or other issues like that? And that has really brought a much more reasonable tone to the conversation about valuation. I think liquidity is a major factor right now.
There are also companies with a long enough operating history that you can stay within the cannabis industry and still take a conservative approach. And so I think that has further driven down valuations, because before it was largely based on future looking assumptions and excitement. And now you can generate a thesis that this industry will continue to grow, will continue to stabilize. And I think that's really positive and makes it worth looking at. But when, pharmaceutical companies that are in the running with a potential solution to COVID, when they're underpriced 10, 20% and giving out 5 to 10% coupons, you have to consider, do I even want to be in this space at this time in general? And then if you make the decision, yes, there's a major question these days around debt or equity. And from a macro standpoint, as a generalist investor, I was reading a report last night. Credit markets historically in downturns like this, or to the magnitude of what we're experiencing right now, credit markets rebound in 10 months, and equity markets take 56 months to get back to new normals. So I think the macro environment, and there was a question about family offices approaching this space in diversified funds or one-off deals. I think this market this experience really forces us all to ask ourselves, why cannabis? And why cannabis, why this deal, why this structure, to Mitch's point. Again, it puts investors, puts the buy side back in the driver's seat, but it also, I think, makes you look at this industry far more rationally. No longer can an operator expect to get funding into a structure that may or may not go down to fumes, and then fund again and just replenish. There is no irrational replenishing anymore, none.
It just took a global pandemic for this realization to hit this marketplace, but it's true.
Well, here's we were starting the raise of our third fund. We were thinking it was going to have a level of distress to it, but then as we started talking and formulating our strategy, we really had a hard time calling it a distress fund. I mean, yes, we're going to be able to see some opportunities that were by definition distressed, but we felt it did a disservice to the industry, because if you think about it, when you're as a distressed investor, you're looking for outsized returns due to decreased margins, decreased top line, all kinds of things that could happen with management. Whatever the case may be, there was some significant levels of distress, too much leverage. All that exists in other industries. The reason there was a downturn in the cannabis industry was almost 100% driven by the fact there's not enough capital. And so we have a hard time calling it distressed. It is come back down to earth and maybe even below that, but that's the opportunity. So when you compare it to one of the questions was, why would I invest in cannabis when I could have, more normalized and distressed assets in other industries? Well, they got a lot more hair on them. Yes, we're federally illegal, but we don't have the debt to deal with, because most of the smart companies didn't take, private loans that were paying 15% current pay. We just have a very low amount of capital and no institutional capital. That gives the ability to invest, to Mitch's point, the opportunity to drive really, really good bargains on the buy side.
Matt, you just said, almost universally that companies didn't take major swaths of debt.
Ryan, you're breaking up.
Yeah, Ryan, we heard
for
about
most public equities, I'd have to imagine that that's one of their greatest concerns, is the fact that they all have very significant debt.
Yeah, no, well, again, I'm speaking, we're private investors. We do have public holdings that have, where companies have gone public, and that is a concern of ours with some of them, but there are some that didn't do the crazy sale leasebacks, that didn't do the the crazy private financings. I mean, Ianthus is a perfect example, way over leveraged, and then look what's happened to them now. But primarily, up until recently, private companies didn't even have access to private lending. And I think the smart operators are the ones that have not been tempted to say, ooh, I can make this 15% coupon work because I'm able to save some equity. The ones that were unwise are the ones I think that did that.
Sure. And 15% was what it came down to. It was 18 to 22 for a while.
Right.
What do you guys think about the current debt environment? I mean, because we've seen things higher than even in the low 20s, up in the mid 20s. I don't know, Mitch, if that's something you've seen.
Yeah, I mean, I think what we're seeing is, and I tend not to think 15% is so bad. I mean, it depends on if you're believing in, your company's projections, because at some point it just becomes a mathematical exercise for the cost of capital. But if you can service the debt, I mean, here's, so we are seeing big returns in debt because there's a lot of different fees layered into them. So what might look like on its face like 15% debt, when you get to OID and agenting fees, but that comes back to like the structure. There's an opportunity to structure these things. A question that was posed was, why is debt become a little bit more of a trend away from equity? And I think a large part of that is, I think equity players they've taken a pretty good beating and they're tired and maybe they're tapped out, but also they raised money at valuations that were pretty high at some point in time. And now for them to raise, it would just be so significantly dilutive that they struggle to get there to accept that money. Whereas if they can, bring in the debt, obviously it's not dilutive. And the key is, can they service the debt, right? And now you have funds, I'm sure like the people on this phone, who have the ability to underwrite a company's ability to service debt, and also its assets and portfolio that supports the debt as well. So I think debt has become more of the flavor of the day because companies don't want to take that level of dilution, and the industry has matured. I think companies can service debt now. They couldn't service debt. I used to work with companies. They would say, we'd love to get a loan. I'm like, yeah, but you can't pay it. You can't pay it off. So no one's going to lend you money. So you have to sell this, right? So we're seeing a lot more debt deals in the space, and it seems if these companies are down at this low valuation currently, but still believe in their long-term vision, and you can believe in it as well, then they would rather do this with debt and get themselves out of this moment rather than give away the store just because of the downturn.
Murray, I can tell you at the lighter end of the debt capital equation, we helped a client secure $3.5 million in debt capital in Q4. It was at 13.5 with fees. It came up to about 15.5 when you really put it together. Same lender, very similar kind of raise in terms of the company and the metrics on the company. And we talked to them last week, and it was 22. So that there's the fear or the current environment, whatever you want to call it. There's no underlying metrics that support that other than COVID-19 or additional anxiety about how the companies are going to make it through the current crisis, whether you want to call it the valuation winter or or COVID-19.
Well, that kind of goes back, Murray, to the reason, to the answer to their very first question about why these companies are beat up more in the public market than other sectors. And I think that so much of what the cannabis industry is experiencing right now are growing pains coming out of infancy. Even the big companies, this is their first time going after, new sources of leveraged finance. And that's a unique time in history. Prior to COVID, I'm nobody, and I was having real conversations with major institutional capital that was just about to come into the industry. Whether it was into things that I cared about or introduced them to or not, doesn't matter. These are, $50+ billion pools of capital are looking at this industry and feeling like finally it's time. Meanwhile, we're in a global environment where there's something like $15 trillion in negative interest rate pools. So there is capital out there that would love to be in the industry getting half of the rates that are currently offered. But it's about the sophistication and the age of these companies. And I think that we're a little bit of a perfect storm right now of companies not planning to have enough cash, then obviously not having it, and a series of gut punches all at once. And so for this, 1 to 3 month time, you're going to see what Michael just outlaid, that what was already pretty rich debt on what might have been a very healthy company has now gone up substantially.
Just real quickly, back on the question about family offices. I know everybody on the call has got some relationships with different family offices. How are they behaving? What should they be thinking about in this environment? Should they sit on their hands and wait for a couple months until you get to the other side, or get active now? And what have they been doing in your interactions with them? Whether it be fundraising, co-investing, on boards, whatever.
For us, it's been across the board. There's some like a lot of different quasi-institutional investors just don't like the fee structure of a fund. So they say, hey, we'd love to invest with you, but only if, we can come in unpromoted, and we kind of shake their hand and say, no, thank you. But we're also seeing a lot of other family offices that have said, look, we have been trying to get our arms around this. We've spent a lot of time and effort and resources to get there. Can't seem to justify doing it internally, so we are starting to look for fund managers. So I think that's becoming for the family offices that are serious about it. I feel like that's more the norm. But there's also, we're seeing a lot of family. I mean, just looking at capitalization tables of our companies, there's still some family offices that we haven't heard of that are getting into cap stacks now, and good for them if they can get access to the deals, because that's really everybody on this call. I mean, that's our secret sauce. I mean, when you've been doing it as long as we have, we get access to deals, and that's what that's what we're selling to our investors that they can't otherwise get. And so if we're not able to do that, then more power to the guys that are getting it.
Right, and Matt, it's beyond access, right? I mean, once you put money out, access to deals, they come, the word gets out pretty quickly that you're deploying capital and people call. It's less, I think, access than the family offices that we deal with. Still, they don't have the ability to. This industry is very like boots on the ground, right? And that's a challenge in these times of COVID. It's not. You have to get out and meet these people and see their facilities. And some you see and you're really impressed, and you can tell a lot quickly when you see a manufacturing facility and you're like, wow, if if the Gatorade company came in here, they could do a deal with this company because this is GMP versus I've seen some facilities that are you're like, I can't even believe this product is making it on the shelves anywhere. So I think the family offices, they don't. We do a lot of work with family offices because that's the backbone, essentially, of the investing community in cannabis, and they're not equipped to spend the amount of time that it takes to really roll up your sleeves and figure out this industry and figure out the players. And the one thing I do think, though, because they are the backbone of the industry, they're also the first people who've gotten hurt, in some of these early bets that they've made. And so they're once bitten, twice shy, but what we're discovering is as we go back to those people now with these companies that they may have invested in previously with equity, that they can now put more money into a structure that gives them a nice return with equity upside and supports their previous investment, that's becoming, where the family offices seem to be interested in deploying additional capital.
We're in a good spot because we do, one of our roles at Primary Growth Partners is we do the due diligence on our clients, on the cannabis companies prior to taking them out and talking with the investor groups that we interact with. So, companies that we've been looking at during this last window of 6 weeks, we've already been in dialogue with, performing the due diligence over 6 to 9 months. So it's not, the boots have already been on the ground, and we can pretty much get a sense from speaking with them and doing Zoom tours of what's still happening and verify the level of activity during this window of time. We find a direct relationship, and we deal with a limited number of family offices, but a direct relationship between the level of the commitment they've planned to make into cannabis is directly relational to where they sit now. So those with a high level of commitment to cannabis, plan to commit a significant amount of capital to it, are quite active. They're looking at transactions. They see this as lower cost basis currently. Those who are sort of in the mid-range are cautious, and those who are sort of putting a toe in the water are primarily sitting on the sideline.
Yeah, and just one last comment on that is that, Mitch is dead right. Deal flow is one, but this is a cottage industry. Everybody's on this call, Murray, as well as anybody, and it takes one phone call to find something out about somebody. It's crazy. And family offices just aren't equipped to do that. They're going to treat this like any other asset class that's in their wide-ranging portfolio, and it doesn't work that way in our industry, which is great for those of us that are entrenched in it.
And here's a shameless plug for Focus Growth Capital Partners, but it's also, this is beyond just like normal investing, because it's so complex regulatorily and legally that, like, even if you're a good investor, I just don't know a lot of family offices that we deal with that would have the ability without us or without these guys on the phone to understand the complexity of what does it take, to get a Massachusetts license. Ryan knows that. It was hard. And it's hard to make that business go, and so an investor might just look at the condition of the market and make certain conclusions, but it's so, I don't know, I really do see the value of funds in the space. Otherwise I wouldn't be involved in one, because I just don't, because I want to get capital to companies, but I want it to be a good deal for investors at the same point in time. I believe in the industry, and the industry needs capital. But the capital will disappear if the deals just keep on, blowing up. So the deals, have to be structured in a way and thought through in a way, and the regulations understood in a way that only some group of people who are thinking about this as their full-time day and night job. Ryan said he's working 7 days a week, 8 hours a day on an operating company in addition to everything else. That's what it takes. Everybody on this call knows that. Right. It's funny now that to be working from home for the last 6 weeks, the family gets to really see like how many hours I can sit in this chair in a day. Cause I don't know what they thought I was doing before, but it's, I just don't know a family office that has the ability to do that.
I'm going to second that and tell you, I'm really jealous of my friends who really are getting a break. That whatever industry they're in, it's really slowed. And look, they've got obviously that comes with all kinds of financial penalty potentially. But, I keep looking going, I'm working as hard as I was before, when's this going to slow down? It's not happening in cannabis. It's, we're full steam ahead.
I push back just a little bit before we come off of this one topic. I would say that I've seen a number of families take their expertise from another industry, come into cannabis with a laser focus, and do really well on that. When I see people come in attempting to have a new list 5 to 20 company portfolio, that's when I see people get into trouble, because you're trying to spread yourself way too thin across way too many complexities. But someone that can a series of I've seen them do really well. I've seen folks. I'm watching someone take a company private right now that just really knows the geography, knows the business, knows CPG. And I've seen that happen really well. So I think, like anything else, if you're focused on one thing, there are plenty of family offices that can wrap their mind around a segment of this industry. But for generalist portfolios, I agree with everybody else.
Fair point. Good point.
So we've had some awesome questions from the audience. Why don't I just ask a couple more and then we'll wrap this up. But first question was, do you have concerns regarding the supply chain, particularly those companies that are necessary to satisfy compliance, such as lab testing, packaging, et cetera, in terms of the companies that you invested in or work with? Have you seen any supply chain issues due to COVID?
Yeah, I'll jump in. I've definitely seen supply chain issues. It's interesting in August, September, October, companies that have been going concerns for a few years recognize the impact of Chinese New Year at the turn of our calendar year, and they prepare well ahead of time. They don't prepare to have backup inventory through July. This is very excessive, and so I've seen. Actually, there are some good friends from Noah Canner's population of attendees who have invested in a number of groups in China that are really struggling. They were struggling, and now they've gotten their feet back under them. So the first few weeks were really hard for a number of these hardware companies, the packaging companies. Up the chain, it was certainly a struggle. You're seeing some operating companies go back to printing labels or printing on Mylar bags, things that we haven't seen professional groups do in quite some time. As it relates to other hardware, lighting, HVAC, things like that, I haven't heard of much of a disruption for those larger items that would be included in CapEx. But timing in general of companies, turning on a new facility or bringing on new partners, new product lines, that's certainly been stunted, partially because of disrupted supply chains.
Yeah, I would say that on our side, we haven't seen this many supply chain issues, but we've certainly seen issues with the cannabis companies themselves getting the product to the customer, because different locales have different rules. For instance, in Berkeley, you have to deliver only, or I know in some areas it was curbside pickup to begin with in Colorado, and then other things like that. And that's kind of changed fundamentally the way people have been operating, and it's been a struggle, but it's hopefully opened up new channels for them long term.
From that standpoint, for sure, that's happened a lot. Delivery companies are seeing incredible growth. Here in Massachusetts, home delivery is up 600%. Wow. I've seen similar numbers in other cities and states. And I don't think that toothpaste is going back in the tube. When you receive product from a professional service, yes sir, no sir, yes ma'am, no ma'am, and it is what you say it was. Why are people going to go back to that? Why are people going to go back to the former process? I just don't see it. So from the last mile standpoint, this industry has been entirely uprooted. I'll give you one very personal example. We have a fantastic store in Central Square, Cambridge, 6,500 square feet. It was a former Blockbuster. We're operating out of 150 square feet of that. That's crazy.
Amazing.
I think in California, we're also seeing this growth in delivery, and it's also equating into new consumers. Surprising percentage of new consumers coming into the space. And I wonder if that's as a result of the increase in delivery business, that it's more comfortable for them to make an assessment of whether they like the product or they want to try this or that, and they're doing more of that through delivery. So that growth of consumer may very well be tied to delivery growth.
They're also at home and anxious, and a lot of stores have started hotlines where you can have questions answered more thoroughly and easier than if you have 15 people waiting behind you and you really don't understand what is CBN or why is this product $70 when this product is $30. You get uncomfortable asking those questions and delaying everybody else. So the technology integration is going to be a very, very big deal and here to stay.
Right, and we've seen like big advances, like I said before, cannabis or COVID accelerating the future of cannabis. Like, you know, a lot of states have loosened restrictions with respect to telemedicine, and, you know, have really opened up. So there definitely I mean, channels have opened up that that may have opened up years hence, but they're here now, and couldn't agree more with Ryan there. It doesn't seem like it'll go backward, you know, that once delivery is started and people see it and it's generating revenue, and people like that channel, I just don't see that, you know, COVID is over and now we're not delivering anymore. That doesn't seem like a possibility.
Okay, we've had a couple questions from folks that probably missed the very beginning, the introductions. And so maybe just to wrap up, if everybody could give their first and last name and the company they work for, and I'm sure that Noah can provide email contact information if anybody wants it. But Michael, why don't you go ahead and start?
My name is Michael Apstein. I'm one of the founding partners at Primary Growth Partners. You can find us online at wearepdp.com.
Mitch?
Hi, Mitch Kulik. I'm a founding partner of Feuerstein Kulik, a 17-person law firm in New York City that services the cannabis industry. And we recently, about 6 months ago, launched a cannabis-focused fund called Cresco Capital Partners. And I'm certainly happy to answer questions that did not get answered today.
Great. Matt?
Yeah, Matt Hawkins, founding partner and Entourage Effect Capital. We were formerly known as Cresco Capital Partners. You can find us at eecpartners.com.
Ryan?
Ryan Anson, co-founder of Revolutionary Clinics and private investor, and then with Potluck Group in Hong Kong.
Great. And I'm Murray Henneke at North Point Advisors in San Francisco. And thanks everybody for being on the panel, and thanks for all the participants on Zoom and on the phone. Appreciate it. I don't know if Noah wanted to come back and say anything at the end, or if we should just leave the meeting.
Yes, I'm here listening in on everyone. Thank you so much for joining us. Thank you for all of our attendees as well. We hope to be able to meet in person one day soon. But thank you all for your time. It was a really great panel.
Great. Thanks, Noah.
Thank you, everybody.
Thank
Thank
you.
Thanks, everybody.